Joining us from Sydney with his view on all this is Colin Whitehead, equity analyst at Fat Profits. Colin, thank you very much indeed for coming on the show. Let's first of all get your view on the logic behind this.
Well, it's a repeat of the previous attempt by Peabody to take control of what they view as a strategically important resource. Of course, Peabody is a major coal producer in the States, and they're really looking to take control of Macarthur's assets in the Bowen Basin on the eastern coast of Australia to service that growing demand and expected to remain robust demand from China for steel-making coal. It's an interesting strategy this time around, more likely to get across the line, because this time, of course, they have Arcelor in tow, whereas before they threw in the bid before getting any of the major shareholders on side.
Yeah, I mean, you talked about the Bowen Basin. Now, that does have a few problems, doesn't it? Heavy rainfall has cast doubt on production there.
The impact from the floods was quite significant, certainly. It is beginning to recede. Macarthur and the other mining companies in the area have been getting back on their feet after that. So it's quite an opportunistic bid in that respect, that Peabody's come in just as things are getting back together, but the dust hasn't quite settled. And of course, it's been launched the day after. Or in fact, Macarthur received this bid on the day that Prime Minister Gillard was unveiling her carbon tax. So that's interesting timing in itself. But of course, the key point there is that although coal and burning coal emits a vast amount of carbon dioxide, all of that coal is going to be burnt in China where there is no carbon tax, and clearly that's why Peabody is quite comfortable with the fact that the carbon tax is held within Australian borders and wouldn't really impact the strategic value of that coal once it's shipped offshore.
Yeah, is that why last time the whole deal crumbled, because it was the mining tax in progress, and this carbon tax, of course, as you just mentioned, is something which will happen, well, they don't get really hit by it because that coal, as you say, is burnt abroad. So what about at the moment how that, is it also a bet, though, because we're going to have Macarthur still have to pay for this carbon tax, we'll have to pay some money. Is it also a bet that the carbon tax doesn't make it through Parliament?
I think that's probably something, well, it's certainly going to make it through Parliament. I think on balance of probabilities you'd have to assume that's the case, unless we had some of the Labour backbenchers crossing the floor. It's possible, but I'd say that's a lower probability event. The more likely outcome would be that we have a change of government at the next election who begin to unwind the carbon tax in its current form. So I would suggest that Peabody may well be thinking along those lines, but certainly, as you pointed out, and I previously discussed, the impact for the coal companies at present isn't quite so severe as it is for other areas of the Australian economy.
Regulatory risks, what about them? We've seen how Aussie regulators don't particularly like foreign companies taking over, and I think they call it Australian sovereign risk. Could that be the real block here, or the hurdle?
Well, the Foreign Investment Review Board, of course, has to approve the deal. That's one of the conditions, in addition to the partners getting over 50% approval. Our view on that is it's probably changed on the back of the carbon tax. Clearly, the government would dearly love to see this deal go through so they could point to it as evidence that sovereign risk hasn't really changed in terms of overseas investors' perception of it within Australia, and that the coal industry is not threatened given a $5 billion deal has gone through. Now, the Foreign Investment Review Board is ultimately a political organisation, so we would therefore suspect that it's more likely to win FIRB's approval this time around than was previously the case. I think the larger hurdle would be getting that initial 50%, but of course that's much more easily attainable than the previous deal, which was set at 75%. So I think on balance we've got to think that this offer is likely to go unconditional.
Very quickly here, Colin, as well, what about other people jumping in here, perhaps also getting these assets? And, you know, people have used the commodities traders such as Noble or indeed Glencore as possible candidates. And what about two companies which own 23% each of Macarthur here? We're talking about China's CITIC Resources and POSCO here as well.
It's possible, but I think at the current pricing they'd probably be reluctant to push too much further ahead, particularly given that the deal could go through with Arcelor and Peabody taking over 50%, but POSCO and CITIC retaining their exposure. So I would imagine, because those two shareholders are on the register for strategic reasons, i.e. securing and maintaining influence over the supply of coking coal, they're going to be reluctant to sell out and be quite happy to maintain their position, but that's not to say that they would necessarily want to overpay for that position by coming in over the top of the current bid. So I think on balance our view would have to be that 15.50 is probably as far as it's going to go this time around, and let's not forget that's 50 cents over the revised bid that Peabody had previously on the table, and certainly it is a hefty premium to Macarthur's current share price, which adds further pressure to the board to actually accept it this time around.
Thanks a lot for that, Colin. Colin Whitehead joining us there from sitting and talking to us about that bid coming through from Macarthur Coal from, of course, Peabody of the US and ArcelorMittal as well.